intercompany transfer of assets. In this learning objective, we're going to look at the equity method of accounting for an upstream sale of a non-depreciable asset, land, in the very first year. We'll have the current year activity between the parent and the sub, and we'll pay particular attention to the special allocation item, the unrealized gain or loss on the sale of the land. We see the parent and the sub's information, and we can see that the subsidiary's income includes an $89,000 gain on the sale of land. Here's the entry to record the net income from the sub and the dividends. Let's address the land itself, and here's the information that relates to the land. It was purchased in July of X1. The sub sells it to the parent, and then the parent is going to continue to hold the land through X4. The subsidiary would make the following journal entry when they purchased the land for $42,000. And when the sub sells the land to the parent, we see that there's a gain there of $89,000. The subsidiary would record the following journal entry to recognize the gain. And we need to ask, is the gain correctly stated? It is correctly stated, but the question is, can we recognize it for consolidation purposes? The parent records a purchase of the land. And this kind of brings us to where we are, where the subsidiary sells the land to the parent, and then we're doing the equity method of accounting during the year. And we do see that the gain is correctly stated, but it's an unrealized gain because the land has not been sold to third parties. So we have to eliminate or recognize this or defer the gain until the land is actually sold to third parties in the future. So what we're going to do under the equity method of accounting is we're going to reduce the income sub by the gain or the deferred gain on the land. We're going to debit income from subsidiary, credit the investment, and the one thing different than the downstream transaction is this will be allocated out between the parent and the NCI, and in this case the parent owns 80%, so they'll get 80% of this transaction. This entry is no different than the downstream transaction other than an allocation of 80%. If we recap everything, it will look like this. And then when we reconcile the income from subsidiary and net income from sub, we can see that the $89,000 unrealized gain or loss is going to be allocated out between the parent and the NCI in the following fashion. We can do our book value calculation. We can reconcile the investment subsidiary. We can also reconcile the NCI account. And we noticed the difference here as compared to downstream is that the gain is allocated to the NCI. So there will be a reduction to the NCI value at this point.